before we get into this thought experiment, probably the most important thing about this presentation is one that I didn't even list on the slide deck because you're probably familiar with it. So notice 2014-21 provides that virtual currency, which basically means all tokens, or at least all fungible tokens. Virtual currency is property for U.S. federal income tax purposes. It's property. However, there's a few issues with that. Number one, the notice doesn't tell us what kind of property, right? Number two, the notice is from 2014, which means that it predates a lot of what's happened in digital assets that really probably excites a lot of us, right? Including the sort of proliferation of DAOs, decentralized autonomous organizations, and of software that that can sort of automate activities that once were relegated to the financial tech world, right? Liquidity pools and whatnot. So that's something to sort of keep in the back of your head throughout this presentation. Now let's do this thought experiment. First, friendly co-venture. Assume 3 friends who live in New York and know each other agree to contribute ETH to a multi-sig wallet in exchange for equal governance over the wallet. And they use the wallet to trade various meme coins. Okay. I think most people would say that's clearly a partnership for tax purposes, right? And as a partnership, technically, there's a K1 filing obligation. Each of the members of that partnership are required to include an income, their pro rata share of the income, gain, loss, and deduction of that partnership. Now I say that, but at the same time, just keep in the back of your head, notice 2014-21, right? There's no explicit suggestion that tokens can be treated as equity, although equity is a type of property. So something to keep in mind. Example number 2, liquidity pool. Assume instead, and this is like the Uniswap example, assume instead thousands of geographically distributed persons acting pseudonymously, right? Crypto tax guy, .eth, and the like, a lot of 0x, addresses. Not sure what's going on here. I have a Zoom poll on my thing.
You just close those, Jason.
Oh, how do I go backwards? Oh, here we go.
Gotcha.
Assume instead, so thousands of pseudonymous people contribute liquidity to an automated market maker, an AMM, which is software that algorithmically quotes exchange prices for specified tokens, right? USDC to USDT or ETH to USDC, etc. Anyone can add liquidity to the pool, right? They can add USDC to the pool in exchange for tokens that represent a share of the pool. And the pool's composition changes as traders swap tokens with the pool for a small fee. Presumably, you're all familiar with automated market makers, but if not, this basically describes them, right? An AMM is basically comprised of multiple pools. Each pool consists of, historically 2 tokens, right? A token pair. So let's say you'd have like a USDC to ETH token pair. You can contribute equal parts USDC and ETH in exchange for a liquidity provider token, or LP token, which represents a fractional interest in the pool, right? And then the pool automatically algorithmically quotes USDC to ETH prices to traders who can trade against that pool by, say, contributing USDC and taking out ETH, or vice versa. And embedded in those quotes are fees, which effectively inure to all of the LP holders, because the LP holders, again, own this fractional interest economically in this ever-changing pool, which includes the fees. That also feels like an entity, right? I mean, under traditional tax principles, if you and I and 1,000 other people set up this sort of trading entity that stood ready, willing, and able to buy ETH in exchange for USDC, or vice versa, for a fee, you'd have no trouble concluding that that arrangement was an entity for U.S. tax purposes. So the question for this presentation and for you to think about is, does the tax law ever distinguish between the above two examples? Because to me, the friendly coventure feels a lot more entity-like than the liquidity pool. And it's hard to explain sort of just at first blush why that might be. So this presentation is sort of about exploring that. Let's go on to the next slide. Okay, so I'm going to go through two situations where this, sort of deemed entity issue on chain might exist. One is DAOs, and then one is protocols. So, so DAOs in general. First of all, I know there's no accepted definition of a DAO, and many people say, look, the vast majority of DAOs are not DAOs, right? They're not particularly decentralized. They're certainly not autonomous in that like the token holders can sort of vote and do sort of chunky actions, right? They're not, they can exercise discretion to take discrete actions, so it's not really an autonomous system. And maybe they're organizations, but that just sort of suggests entity treatment. But let's sort of think about what DAOs might be in order to at least formulate a sense of of what we mean when we say DAO. I just caution that sort of in your daily practice, using the term DAO is not particularly descriptive, right? I think we need more we need either better terms, or we need to just dispense with terms and take sort of a long form descriptive approach for anything we describe in this space. But a few things that I'm thinking of when I mention DAOs. One is a social club, right? So Nouns DAO, if you're familiar, Friends with Benefits, if you're familiar with that, it's like anyone who owns a token, is just a member of the social club that uses the proceeds of the issuance of tokens to set up cool bar events in New York and whatnot. One is an investment vehicle. Flamingo DAO is a good example. Syndicate.io is actually a website that you can go to and have an Insta DAO. Like it'll spit out a DAO. It'll even give you the option of wrapping the DAO in an LLC, which we'll talk about shortly. Purpose-driven organizations. So, I might want to raise money to buy the Constitution, which is what, or an old copy of the Constitution at least, which is what Constitution DAO did. Assange DAO raised money to support, Julian Assange's criminal defense. Or protocol governance. MakerDAO is a good example. Aave, Curve. These are governance tokens that sort of democratically flip switches in protocols, right? So in a lending protocol, there might be different interest rates that are charged depending on the collateral, and the protocol governance of the relevant protocol might set those parameters. I listed Tezos as well, which like you might you might be surprised to see. Tezos is a blockchain, but it actually also has on-chain voting for, for example, upgrades of the entire blockchain, right? Forks. So one might consider the XTZ token to be a governance token and a DAO as well. So a lot of different use cases and potentially a lot of different types of functionality, within the types of tokens that we refer to as DAO tokens. Protocol tokens. So what do I mean here? Because technically a DAO is a protocol as well. What I mean here, and I don't really have a great word for it, is a token that represents a fractionalized interest in an automated protocol or an automated pool. So LP tokens, in other words, tokens that represent a fractionalized interest in an automated market maker, which is what I described in the first slide. A tokens and C tokens, which represent interest in automated lending protocols. So, they're very similar to LP tokens in concept. I can contribute liquidity to a lending protocol, let's say in the form of USDC, the stablecoin, in exchange for an A token if it's Aave, or a C token if the protocol is Compound, right? And in effect, the actual devs here would sort of wring my neck probably, because I'm about to describe it not entirely accurately, but in effect, my A token or C token, represents the lender, right? And people can borrow that USDC liquidity by putting up collateral, let's say ETH, and sort of over collateralizing their loan. And then pursuant to the terms of the protocol starts liquidating their collateral if their over collateralization ratio, being the amount that they borrowed compared to the amount of collateral they put in, drops below a certain amount, so that as long as the protocol works, I, as the lender, am always sort of protected, right? And I'm also, in order to re-access the collateral they put up, they have to return interest as well as the principal that they borrowed, so that I and all of the other people who contributed USDC in exchange for A tokens or C tokens am in this sort of arguably joint venture that is earning fees by lending money to people. Yeah, question. Liquid staking tokens, also kind of a similar concept, right? A lot of these concepts are of like providing liquidity. They're these primitives that the decentralized finance world has built on top of. Liquid staking tokens represent fractionalized interest in a staking pool, right? We all contribute our ETH into a smart contract, which is a software that lives on chain, and the smart contract non-custodially allocates our ETH to stakers. Those stakers earn staking rewards with that ETH. The smart contract automatically streams, let's say, the top 10% or the top 5%, depending on your protocol, to those operators, those staking operators, and streams the remainder of the rewards to the pool. So in effect, my liquid staking token, whether it be RETH as an example, or staked ETH or wrapped staked ETH, represents this fractionalized interest in a pool of ETH, and hopefully an ever-growing pool of ETH. So when are these things tax entities, right? or I guess to start with, just what does the law say? When is an arrangement a tax entity? So, you start with the tax code, section 7701A2, which actually defines partnership, but you can sort of look at that as, maybe the starting point for determining whether you have an entity. And it gives this definition that's really not helpful at all, because it seems to be over-inclusive, right? A syndicate group, like a group, is an entity. But clearly a bunch of people standing on an elevator, are a group, but they're not an entity, right? However, they say through or by means of which any business, financial operation, or venture is carried on. But again, that's not particularly helpful. There's no definition of venture. It's not entirely clear what it means to carry on a venture. Does the group have to carry on the venture? Does some sort of, I don't know, does the group have to carry out an venture in sort of some separate name, or does each member of the group carrying on a venture on their own sort of collectively constitute an entity? It's not that helpful, right? So typically the courts actually have not even looked at 7701A2. We'll get to sort of what the courts have done in a moment. The regulations are slightly more helpful. They provide that a joint venture or other contractual arrangement may be an entity if the participants carry on a trade, business, financial operation, or venture and divide the profits from it. Okay, so that's like slightly more helpful. I emphasized or other contractual arrangement. I don't. There's not any authority that I'm aware of that explicitly, parses those words in this context. But one might infer from this language that there's this suggestion that there needs to be some contractual arrangement. Maybe express or implied, but some arrangement nonetheless, in order for an entity to exist, right? A joint venture or other contractual arrangement. Okay, and then let's look at what the courts say. Well, if you look through the case law, it's sort of all over the place, but really largely all points back to Estate of Luna, right? Which is an old case that provided eight sort of weighing factors for determining whether an entity exists. And I list out the 8 factors here, but going through them, you could sort of see that they really come down to 2 tests. Number 1 is the intent of the parties and their activity in relation to that intent, right? Did they act consistently with that intent? So did our 3 friends in New York intend to form a partnership, and did they act consistently with that intent? And then 2, whether there's property co-ownership. So did our 3 friends in New York, co-own property? And by the way, you can sort of see that in meat space arrangements as well. I work in the fund space a lot. Imagine that you have someone who provides capital to a venture. I know saying venture almost like gives away the thing, but just bear with me. Someone provides capital, and then someone else provides services, right? If the provision of capital is to an LLC and the provision of services is to an LLC, you could easily describe the services person as a services partner, right? Typically, that's like your general partner in like a hedge fund type, investing partnership, right? And they would be able to treat the incentive compensation that they receive in exchange for their provision of services as a partnership interest and as a carried interest, and potentially as a result be able to get long-term capital gains on the payment because they are respected as a partner, as a carried interest partner or a profits partner in this partnership. Assume instead that the parties just effectuate the same arrangement pursuant to a management agreement. I hire investment manager to manage, my, pool of money that I, put into their custody. And in exchange, they get, let's say a management fee that includes an incentive component, or let's make it even easier. They only receive an incentive component, consistent with my partnership arrangement. The IRS would not assert, or has not asserted, that arrangement is necessarily a partnership. So there seems to be a lot of focus on intent and consistency, to the extent that 2 economically identical relationships can be viewed very differently from each other, right? And I think so it's worth noting that intent and consistency seem to be probably like the most important of these 2 elements, and then property co-ownership seems to just almost test that requirement. So 2 other things to keep in mind. We're drilling down a little. Let's keep going. So what happens if you have an entity? Right. Let's assume that our 3 friends in New York have an entity. But what's the consequence? So number 1, that entity, that deemed entity, would have to file partnership returns and send out K-1s. And if it's in a U.S. trade or business, it has to withhold on non-U.S. partners, right? Start thinking about sort of larger, investment DAOs, like 100,000 people contribute ETH to a DAO, like the DAO, the first ever DAO, right? In exchange for governance tokens. And then that DAO goes and makes investments. So, imagine this DAO that has no actual like centralized control if it's if it's set up to really be governed by software. Technically has this tax return and K1 filing obligation. Each partner of the DAO is taxed on a pass-through basis. They need K1. I mean, technically, they're supposed to get K1 so that they can determine their share of income. Although I guess, using sophisticated enough blockchain analytics or just like really, really carefully parsing Etherscan, maybe you can figure it out. There's this additional question of who the partners actually are, right? Some DAOs, particularly very large DAOs, they might have some part of their treasury sort of democratically governed, but they alternatively might have some part of their treasury governed just by a committee of multi-sig signers, right? In the interest of efficiency. Maybe the DAO has the ability to appoint, remove, and replace multi-sig signers, maybe not. There are these sort of factual questions that might lead you to the conclusion that just the multi-sig signers really own everything. In theory, in some DAOs, the multi-sig signers can just run away, right? And that's actually happened. Like many DAO token holders have been, so-called rugged, right? They thought that they owned a fractional interest in a pool, but in fact, the founders all just sort of colluded to drain the multi-sig into their own individual wallets, and suddenly the governance tokens were worthless. Did they ever own a fractional interest in the pool? Were they ever really partners? That's sort of, a separate line of questioning. And then, last consequence for partnership treatment, non-U.S. partners could be required to file U.S. tax returns and pay U.S. income taxes. Again, if the partnership is in a U.S. trade or business. Of course, that begs the question of like, how do you determine whether this decentralized thing, or at least, partly decentralized thing, depending on sort of how active maybe the founders are, how do you determine whether it is in a U.S. trade or business to begin with? So that's if your entity is a partnership. You can see that this is getting really, these questions are sort of snowballing really quickly, and soon we'll reach an avalanche on the next slide. So just bear with me. If the DAO is a corporation, or this applies to these obviously apply to smart contracts as well. If your sort of arrangement is a corporation, and it's domestic, it owes U.S. corporate taxes, and any distributions it makes might be dividends, right? Dividends would be subject to withholding tax to the extent that they're paid to foreigners. So think about a liquid staking token like staked ETH offered by Lido. You could imagine the IRS saying that, oh, this liquid staking token is really stock in a staking arrangement, right? All of the equity, all of the sort of capital members are contributing, ETH to a joint venture. That joint venture is, hiring stakers to do the work. It's paying those stakers a fee in the form of incentive compensation. And then staked ETH actually just pays the remainder out currently to the holders. So again, you're sort of like, oh, wow, are those dividends? Do we have to determine the earnings and profits of this entity to determine whether they are dividends? If they're dividends, then the entity, if it's domestic, has to be withholding on foreigners. Obviously, it's not doing that. Lastly, if you have a foreign corporation, if it's engaged in U.S. trade or business, it's subject to corporate tax, to U.S. corporate tax, potentially to the branch profits tax as well. So a 30% hit on top of U.S. corporate tax. Or if it's not engaged in the U.S. trade or business and all of its income is not subject to U.S. tax, maybe it's a passive foreign investment company, a PFIC, or a controlled foreign corporation, a CFC. In either of which cases, U.S. holders could be subject to material adverse tax consequences. And now the avalanche. So you know the consequences, but how do you even determine where you are? The first question you have to ask, if you determine that there's an entity, that like a DAO or a liquid staking token or an LP unit, or an LP token rather, or an A token or a C token. If you determine that those are equity in a deemed entity, you have to ask what the entity is, right? I sort of skipped that. I just said, well, if it's a partnership, then this. If it's a corporation, then this. But how do you make these determinations? Well, typically under the regs, 301.7701-1 through 3, you first have to ask, is the entity domestic or foreign? And the regs say, well, that's easy. Where was the entity created or organized? An entity that was created or organized in the United States is domestic, and an entity that was not created or organized in the United States is foreign. And by the way, the regs say, if you have an entity that was created or organized in both the United States and elsewhere, it's still domestic. And we know that the regs were intended to get at dual chartered traditional entities there, but that might actually be, sort of a trap for DAOs, right? Maybe you have developers who launched a smart contract, both, and some of those developers were working in the United States and some were, working in Israel. Well, maybe the IRS says, oh, that entity was created or organized in the United States and in Israel, and accordingly is a domestic entity. If it's a domestic entity, then the default, before we apply the so-called publicly traded partnership regime, would be that it's a partnership. If it's a foreign entity, then we have to ask another question to determine whether it's a partnership or a corporation. And the question is, do the members have limited liability? If all members have limited liability, then you default to a corporation, so you have a foreign corporation. If any members has unlimited liability, then it's by default a partnership. The regs unhelpfully provide that the limitation of liability is based solely on the statute or law pursuant to which the entity is organized. Well, we don't have a law or statute pursuant to which these entities are organized. We're dealing with this weird hypothetical deemed entity. So it's not entirely clear how to apply these rules. Lastly, even if the entity defaults to a partnership, you do have to ask, is it a publicly traded partnership? So PTPs are partnerships whose interests are readily tradable, and readily tradable is very broadly defined in this context. So, I think most liquid fungible tokens would be readily tradable. They don't have to be listed on a centralized exchange or anything under this definition. There just have to be sort of readily available secondary market quotes, which there would be if you have trading on Uniswap. And those PTPs are taxed as corporations if too much of their income is active income. If it's 10% or more of their income is active income. And active income is basically any income that is not listed in the statutory passive category under 7704. That would include presumably fees. So like, let's say you have a protocol DAO, like your Maker DAO, or let's say the Uniswap, Uni token holders, or there are Aave tokens that govern the Aave lending protocol. There are compound tokens that govern the compound lending protocol. Those, I believe that, in many cases, if not most cases, there is a treasury that is receiving or can receive streamed fees. Some of the trading fees or lending fees or whatever are sent to the liquidity providers, but others are sent to this treasury governed by the sort of protocol, DAO governance token holders. So, maybe you say, well, those are publicly traded partnerships, taxed as corporations, and I own stock in them. Very, very, weird. We're sort of dancing on the head of a pin here. So I'm gonna keep going. Note that in all these cases, there's not a centralized person to actually pay taxes, withhold, file tax returns, etc. So, there's a question for us Americans, which is, okay, like a lot of these things might be entities. If I own wrapped staked ETH, like maybe I'm a stockholder, or if I own maker tokens, maybe I'm a stockholder, and maybe this entity has entity level tax. If it's a partnership, obviously, I also have sort of direct liability for my share of income. But like, what if it's a corporation, and what if I determine that it is for a domestic corporation, and I'm an American, and it's not making distributions, or maybe I determine it's a foreign corporation and it's not a PFIC because all of its income is like dealer income, so it's active. So am I off the hook? Right? Like, can I just say, well, look, IRS, you said in 2014 these tokens are property, even if you really meant that they're like stock, sort of same, right? It's capital asset. Well, you do have to consider whether the IRS might assert some kind of joint and several liability for the holders. If you look at the CFTC's UkiDAO complaint, the CFTC, asserts that, well, under this sort of state law partnership concept, all members of a DAO, which the CFTC, by the way, defines as all voting members, but the IRS might take a different approach. All members are jointly and severally liable for the DAO's liabilities. I don't know, could the IRS assert a similar argument here? We don't know, but it's sort of a scary thought, right? At least for those sort of heavily exposed to the crypto ecosystem, or with clients heavily exposed. Okay, that was a lot of information. Take a step back and let's look at one alternative, maybe a little less scary, but it's it's a possibility, and can be scary nonetheless. What if the IRS just says, look, like, we're not going to assert that your liquid staking tokens or your LP tokens or whatnot are interested in an entity for whatever reason. I mean, I'll go through why these might not be entities in a moment, but let's say the IRS says, we're not going to assert these are entities, but you can't just be accruing fees that aren't taxed to anyone, right? I mean, we're all, lawyers and accountants in this group. Like, doesn't it strike you as odd that, you have these protocols that are earning fees just sort of into the ether, I guess literally into the ether, and we own tokens, and we're just claiming capital gains or losses when we sell those tokens, even though sort of inside the tokens there are these fees accruing that, if paid to us directly, would be taxed currently and at ordinary rates. There's something weird about it, right? And I know, having spoken with Treasury officials, that something smells fishy to them as well. So maybe they say, well, you have to look through. Now, one, I would note, like, same breath, we do have Notice 2014-21, which says tokens are property. It doesn't say tokens are disregarded property. So, maybe you have, maybe you at least have a reasonable argument that, like, the IRS can't do this without changing its current guidance. I don't know. But at the same time, you have IRS guidance that says that airdrops are ordinary income, right? Now, take the Uniswap protocol. If I own Uni tokens, I believe there's a fee switch. I'm not sure if it's been turned on yet. Someone who's like heavily involved in that ecosystem can tell me. But regardless, I do know that the Uni that the Uni protocol, Uniswap tokens, Uni tokens, are currently streamed just on an ongoing basis to the protocol treasury. And the IRS has said that airdrops are taxed currently as ordinary income if I receive them, right? So, like, if I were receiving those Uni tokens directly, like my share of the Uni tokens, I'd just be taxed currently at ordinary income rates on these newly minted tokens, which, as an aside, is an insane tax position, but it's the IRS's tax position. So I'd be taxed at ordinary income rates, but because the tokens are streamed to a treasury, and I only own a fraction of the treasury through my ownership of, my direct ownership of Uni tokens, I'm not taxed on the those sort of airdrops? I don't know. I mean, I'm sort of pointing out notice 2014-21, but it seems to be in conflict with this more recent guidance under which airdrops are taxed as ordinary income. So something to think about. So maybe the IRS says, oh, you have to look through. There'd be an issue there, right? Number one, US token holders would have to determine their look-through income, which might be really hard, right? Like we all have Etherscan, we've all looked at it before. Maybe the accountants in the room or in our virtual room have looked at it more carefully than I have, but it's not that easy to parse, right? Particularly if you have a really complex set of transactions going on underneath. There is a question of sort of how deep you have to dig if you have sort of recursive transactions or transactions on top of transactions. Like just how far do you look through in the stack of things occurring? Also, there's something weird about look-through treatment, which is that like, okay, if you look through my liquidity provider tokens, am I a dealer suddenly? Like am I a dealer in commodities? So I have to mark to market under 470, or not I have to, but I can elect to mark to market under 475F all of my commodities positions because I'm doing enough dealing in commodities through my holding of, let's say, a single LP token. Like that doesn't really seem like the right answer either. So, look through, I don't know. It sort of gives rise to additional questions, just as entity treatment does. For non-US holders, there'd be, again, the question of like, well, if they're looking through, what are they looking through to? Do they look through to a US business? If, let's say, an American deployed the relevant smart contract that is, giving rise to the fee income, how do you even determine if someone in the United States was the person to deploy that smart contract? Or do you look at who developed it? All these questions that we just don't have answers to. So far, my presentation has been about, oh, wow, we have this problem and we don't have any answers. That's not particularly helpful for tax practitioners. So let me offer a few potential guidelines. And I made these up, right? I thought about this for a while, maybe slightly longer than some of you, but time is finite, right? And I came up with a few guidelines for developers that are considering launching a token, whether it's a fractionalized interest in a protocol or governance token over that protocol. And here's sort of a framework. Now, at the outset, I'll note that that the vast majority of DAOs out there, probably governance DAOs, I mean, probably don't satisfy this framework perfectly. But it's a framework, right? So at least it's something. It's sort of a way to start thinking about these issues, and maybe if you're advising a client who is considering launching a token or considering investing in a token, and they want to determine what the token is for tax purposes, and you want to be at a high level of comfort. Maybe in the first instance you say, well, look, the IRS says tokens are property. We're just going to treat them as property until the IRS clarifies. But if it might not be the greatest answer for someone with a lot of money on the line. That all the best you have is sort of some 2014 notice that hasn't been updated. So here are a few again sort of guidelines that you might use to think about whether or not you have a potential entity. So number one is the more pre-programmed something is, I would say the less likely it would be to be looked through or treated as equity in an entity. So like in my Uniswap example, where you have constant inflationary uni tokens streamed to a treasury. When I bought my uni token, my direct uni token, what I was buying was a uni token that was effectively pregnant with that inflation, right? My purchase price represented the present value of that future inflation because the inflation is hard coded. So maybe you have an argument that that, look, there's no look through because that would effectively be a double tax. I've already paid, I already have basis for that future flow. Now, I have some caveats here. You can read them. I don't want to, I don't want to go too much over the time that was allotted to me for this presentation. I know you all have, other things to do, but one is the obvious, like the IRS probably will hate the idea of fees or what it considers income being streamed to some place, some locus on the blockchain where it is not taxed. So like you have that to overcome. There's a counter argument. Well, forget it. I'll say the counter argument. The counter argument is that like if you that if the value already reflects the present value of the projected fee stream, it's just sort of unclear what the theory is for forcing current tax accrual. And you can consider the OID rules that were promulgated in 1986, right? Before those OID rules, if I bought a $70, a zero coupon bond for 70 that matured at 100, you could sort of think of that bond. And in fact, economically, what that bond is a bond that just pays current interest in new bonds, right? In new mini bonds over the course of its lifespan, which in fact is under the OID rules how it's taxed, right? It's taxed, on the $30 of sort of imputed interest is taxed under a constant yield method, which is effectively as if like the first interest payment, you got a mini bond, second interest payment, you got a mini bond plus another mini bond, which reflected interest on the first mini bond, third interest payment, more and more, et cetera, so that the amount of interest you accrue increases over time, right? And without the OID rules, the IRS, would not have had a basis for taxing that current accrued income, right? So the theory here would be like, look, like same thing. We're in this new place. Sure, like I'm buying this fee stream. Maybe there should be some amount of like of income inclusion and maybe basis recovery, like under like an installment sale almost. If I buy like a uni token that effectively has embedded in it, future flows of uni tokens, but we don't have that type of guidance from Congress. So the IRS is sort of powerless to require it. That's one argument. Another caveat just to mention is that like many of these protocols go through upgrades, and each subsequent upgrade sort of weakens the argument that this was all pre-baked. For that, I look to the 2023 CCA on the Ethereum merge that said that if I held ETH through the merge, I didn't have a taxable event. Similarly, maybe any other protocol upgrades that are like merely upgrades to the operation of the protocol are not taxable events for me. So like if if I own, again, like if I own maker tokens or something, and the maker protocol upgrades, and in the upgrade the developers include the same fee switch that was in version 1, but they include some like new value accretive structure similar to the gas burning in current Ethereum, maybe that's still just not a taxable event to me. And if there's no taxable event, then it's unclear what the theory would be for requiring me to accrue income currently. Okay, so number one, pre-program. Number two, wide distribution. Obviously, the wider the distribution, I shouldn't say obviously, but in my view, the wider the distribution of a token, the harder it is for the IRS to assert entity treatment. And why is that? Going back to that regulatory reference to a joint venture or other contractual arrangement. Look, three friends in New York, if they have a dispute, even if they don't have a signed contract among themselves, a New York court could step in and settle that dispute. 100,000 people spread out all over the world and acting pseudonymously, not even with each other, but with software that sort of intermediates their relationships. That looks a lot less like an entity, right? That looks like a bunch of people using software. And then, the vast majority of DAOs that like you and I deal with on a daily basis are somewhere in between. You want to get closer to the, massively distributed protocol governance than to the three friends in New York, right? Avoid referring to a joint venture. This is sort of obvious. Maybe don't even use the term DAO because it has the word organization in it, right? Really, all of this should just be software parameter selection, right? I don't think it seems difficult for me to envision the IRS referring to holders of XTZ as an entity for tax purposes just because Tezos has on-chain voting, right? But it's not that hard for me to envision the IRS, treating the DAO, one of the DAOs that I'm a member of, which uses aggregated ETH to buy the works of the artist X Copy. By the way, some of those works are behind me if any of you can see them in the shadows there. It's not hard for me to imagine the IRS asserting that that's an entity for tax purposes, right? Because we're only like 50 people. And many of us are doxxed. So, something else to consider. Avoid an active business. Decentralized software parameter selectors can't hire people. Entities can. So ideally, really, again, ideally, but not always realistically, all actions are on chain and they're just sort of parameter selections. They're not, people literally going out and negotiating contracts with other people. Avoid treasury diversification. This is a cute one that I sort of thought about. So as you all know from the Luna factors that we went over, property co-ownership is suggestive of an entity, right? It's like really one of the two major factors in Luna. But tokens can't simultaneously be equity in an entity, deemed equity in an entity, and that entity's property. So like, if I own uni tokens and then the only thing that the uni token, the uni treasury, the community treasurer owns is uni tokens, that means it owns its own stock, right? But an entity that owns its own stock doesn't actually own any property. So maybe it isn't actually an entity. So you sort of end up in this paradox. Something to consider, right? Lastly, keep the ownership by the founders small. Really, the most sort of offensive thing, to me, if I were an IRS official, would be, I'm a developer. I'm gonna create this protocol that earns fees. I want to earn the fees, but I don't want to pay tax currently on them at ordinary income rates. So I'm going to create a token. The fees go to a community treasury that is governed by the token holders. The token holders can, vote to have that treasury sort of distributed out to them pro rata. And I'm going to allocate the entire, 90% of the tokens, the governance tokens, to myself. Well, look, I've just converted, current ordinary income into deferred long-term capital gains. That's, I think, just sort of intuitively the sort of most obnoxious thing that you could sort of put before the IRS. So encourage your clients to avoid that. Okay. Lastly, as I said, and this is great because we have 5 minutes left, and I'm going to end. I'm going to end right on time, I think. As I said, a lot of those guidelines just cannot be followed by lots of DAOs, right? So some DAOs just plan into entity treatment, and that's totally fine. But there are different ways to do that, right? So one is what people call wrapping. A lot of people refer to wrapping, and they're actually, I think, in my view, they're sort of misusing the term. When I say wrapping, I mean literally the DAO is an entity. So you set up an LLC or an unincorporated nonprofit association. You define in the relevant operative agreement the interests to be, those interests that are owned by those tokens that are owned by, people who own that are specified at the following, like an Etherscan address or whatever, right? Those are the shareholders, or those are the LLC members. Now, obviously, that probably means you have to KYC all those people, right? It probably means that under the Corporate Transparency Act that came into effect this year, you have to identify those people to the to FinCEN. It might, it might implicate other regulatory requirements, but that's wrapping, and arguably that's the safest, right? You can make a check the box election, treat it as a corporation, and basically what you have is just a traditional entity with a fancy front end. That fancy front end being these tokens, but that's not crypto, right? I mean, yeah, okay. Come to your own views. Something very, very common, and something you should all be aware of, even if you're not setting up DAOs, but just advising investors in governance tokens for protocols. Very, very common is a foundation model. In the United States, we see U.S. teams set up their foundations in the Cayman Islands, but there's also Swiss companies, Singaporean, etc. But I often work with the Cayman Islands. What often happens, and I'm going to generalize a lot, but a development company develops a protocol, and they want to decentralize governance by creating a token, a governance token that that might have a fee switch that they can vote to turn on, and then also can sort of allocate funds to developers, including this original development company, by the way, to to continue building out the protocol and do hold bug bounties and what have you. They set up a Cayman Foundation to hold the community treasury. And then Cayman corporate laws are extremely flexible. They allow for the organizational documents of that Cayman Foundation to require the Cayman directors to basically abide by the wishes of the token holders, right? So in effect, the token holders own the Cayman Foundation. Now, legally, the foundation is a non-stock corporation, and it's a nonprofit in the Caymans. But from a US tax perspective, it's just a foreign corporation, right? And the foundation might hire the development company that spawned it. It would pay the development company, it's typically like cost plus 10% for any work that the development company continues to do on the protocol. And then you have the governance token holders who hopefully become sort of more and more widely dispersed and decentralized as the original founders sell off their tokens into the market, right? You have to wonder whether, as a token holder, we've spent this entire slide deck sort of talking about like unwrapped DAOs and whether those are entities. But now now I'm describing something where I might have a governance token that represents, at least in part, true equity, tax equity in a true corporation. And then you have to ask, do I own a PFIC? Is my token for US tax purposes stock in a foreign corporation? That's a question that hasn't really been answered. But I know that, particularly larger investors do have that question. Just as a reminder, if I own an interest in a PFIC, and I sell that interest at a gain, I'm subject to potentially very adverse tax consequences. I have to prorate that gain over my entire holding period, and I'm taxed as if I had owed tax on the prorated portion for each year, plus interest. And in the end, the net tax liability might actually exceed my economic gain. So it's really problematic, and there's not always a good way to get around it. But it's something that you really should be thinking about as tax advisors as well. And I just sort of went through all of this. So my conclusion is, I don't have a conclusion. There are a lot of questions. There aren't a whole lot of answers. I'll make one observation. The IRS, according to the latest statistics, audits 0.05% of partnerships that it knows exist. In the on-chain world, we potentially have partnerships everywhere. Whether or not the IRS knows they exist is a question. And honestly, it might be the case that we just have a lot more tax non-compliance. And that's also something to just sort of think about as practitioners in the space. How do you advise clients when maybe maybe non-compliance from a pragmatic perspective is sort of the middle of the road approach. And I told you I would end with a little point about Farcaster. So Farcaster is a decentralized social media app. On top of it, you can build like mini apps. One of those apps is called Party DAO. In effect, you can create a DAO with one click. You say, I'm starting a party, click. Anyone who contributes 0.01 ETH to this gets governance. And then we can collectively vote on, what NFTs floors to sweep or something. So boom, you have a partnership. Maybe, under like the rubric that I've provided. What do you do with that? Who's liable? How are people taxed? Just things to consider.